Okay, Olamide, can you hear me? Olamide, please make Olaronke the host.
Okay, on it.
Okay, Olaronke, are you set for us? Please, the profile. Olaronke, are you there? Okay, Emike, can you hear me, Emike?
Yes, I can.
Okay, just go ahead with the reading, please.
Pardon me, please give me a minute. Can everyone hear me, please?
Yes, go ahead. We can hear you.
Okay. Speaker of the day is James Church. James Church is the author of the Amazon best-selling book, Investable Entrepreneur: How to Convince Investors Your Business is the One to Back, and co-founder and COO of Robot Mascot, the UK's leading pitch agency. He's on a mission to stop great ideas failing due to poor communication, and is frustrated to see so many founders struggle to raise the capital they need because they are unable to convince investors their business is the one to back. James is passionate about working with founders to present a clear, concise, and credible business case to investors. James has been featured on numerous industry blogs and podcasts, has run mentoring sessions at Tech Hub, Google Campus, and Runway East, and delivered mastermind sessions for the Chartered Institute of Marketing, University College London, and University of East Anglia. So, ladies and gentlemen, Leaders Fourth Company is pleased to present to you the author and co-founder of Robot Mascot, James Church.
Thank you very much. An amazing introduction. Thank you. So yeah, let me share my screen and we'll jump straight into it. So today I'm going to, here we go. There we go. Hopefully that can be seen. I'm going to have the chat open. So if you get any questions throughout today's session, feel free to pop them in the chat. I'll do my best to come and come to those and answer those questions. So that would be great if you could do that. So today I'm going to talk to you about how to become an investable entrepreneur. I'm going to talk you through the key strategy that forms the basis of my book and start to share with you how you can start to approach your own fundraising rounds and how you can position yourself for raising investment. But before I do it, a bit of an introduction. I think most of it was covered there, but I'm James Church. As was said, I'm the author of the best-selling book Investable Entrepreneur, and I'm also the co-founder and COO at Robot Mascot. And at Robot Mascot, we create investment materials that convince investors. And when we do that, when we create these materials, our clients become 40 times more likely to raise the investment that they need. And as a result of that, as was said in the introduction, we've become recognized as the UK's leading pitch agency. We actually work globally with clients. We've got clients in South Africa, in Australia, in America as well, in the USA. So we actually work globally with investors to create these assets. We've got some incredible partnerships across the industry. We're trusted by the likes of Crowdcube, Seeders, Dent Global Accelerators, Seed Legals, a number of other capital raising partners as well, to produce these assets to get our clients investor ready. But really, at the heart of what we do at Robot Mascot, what we want to see is great ideas and innovations flourish. So we just get really frustrated at seeing all of these incredible ideas fail to raise investment because of poor communication, and we want to put an end. We want to put an end to that, and we want to see all of this incredible amount of money that's being invested into businesses go to as many founders as possible. So I want to start today's session with the idea that there's more opportunity, there's more ideas, and there's more possibilities than ever before for you as an entrepreneur. We're really privileged to be living through such transformational times. You know, the internet kicks off what's now referred to as the third industrial revolution, and we're seeing a shift in technology that we're only midway through. We're only at the beginning of the journey. We're yet to fully realize where we're going to go through this entrepreneurial, this technological age. And this has created a huge amount of opportunity for founders all over the world. And it's really empowered entrepreneurship. We really are living through the golden age of entrepreneurship. An entrepreneurial revolution is what's happening worldwide. And this is kind of what's been happening in that time. So over the last few decades, in the 2000s, it was all about the dot-com boom. The innovation was all around the dot-com boom. In the 2010s, the innovation was around 3G, cloud computing, GPS and smartphones. And this allowed companies like Uber and Airbnb to exist. It allowed them to become the unicorn businesses that they are. They wouldn't have been able to do it had there not been a development in the underlying technology that they use, smartphones, GPS, 3G. And as we look through the 2020s, we look at and consider what's going to be happening this decade. At the moment, it's all about the Internet of Things, 5G, blockchain, machine learning, AI. These are all in their infancy as technology, and it's really going to develop over this next decade, and it's going to provide so much transformation that we can't really comprehend quite what that's going to look like. But if we were to all get together as a group in 2030 or 2032, in 10 years time, and we were to look back at the most successful companies of the past decade, of the 2020s, I can almost guarantee that the Ubers and the Airbnbs of the day, the ones on the tip of our tongue, will be leveraging Internet of Things, 5G, blockchain, AI, machine learning in some way, shape or form. And all of this innovation, as a result of this, there's never been more money available for investment into businesses, whether they're technology businesses or not. There's just an appetite for investing in entrepreneurs. And over the past decade, as a result of that innovation, as a result of all of that entrepreneurial opportunity, we've just seen unprecedented growth in entrepreneurial investments. So we're currently living in a time and a place. If you've got $1 billion idea or even a multi-million dollar idea, there's hundreds of thousands of people out there with the capital to fund it. There's the crowd, there's angel investors, there's VCs, there's family offices. There's literally whole organizations set up with the sole purpose of giving you money. Now, this is the result of that. This is the result of all of that innovation. 450% growth in the amount of capital being invested into businesses like yours, startup and scale up businesses over the last 5 years. Look at what's happened in 2021 as we come out of this COVID lockdown of 2020, which, by the way, 2020 was a record-breaking year despite all of the COVID lockdowns, despite business being completely disrupted for the best part of a year. It was a record-breaking year for the amount of investments. But look at that jump in 2021. The last year, we saw a record-breaking $121 billion invested across Europe. So these are the figures for Europe. The same is true worldwide in the three major kind of tech areas, whether you look at the Americas or whether you look at Asia. We're seeing incredible amounts, more than ever, being invested into businesses. And it's a huge growth. And it seems kind of counterintuitive, right? To think that we're in the midst of a global pandemic. There's uncertainty around a lot of markets. There's financial uncertainty for a lot of businesses, yet more money than ever is being invested into startups. And that's because investors are looking at the stock market and they're seeing that it's rather volatile. There's been loads of economic stimulus pumped into various economies. And as a result of that, there's thoughts that there might be a crash soon. There might be a huge amount of redundancies as that economic stimulus from governments is taken away. So they're investing into entrepreneurs instead. And the same happened in the 2008 global financial crisis. 2008 and 2009 were bumper years for raising investment. It was when Uber, Airbnb, WhatsApp, Instagram all got their first major rounds of funding. And there was a considerable amount of investment for a 3 or 4 year period after that before things started to plateau. There was a huge amount growth. And the same thing seems to be happening this time around. A result of a unpredictable and volatile stock market means good news for entrepreneurs, because there's more money being pumped into entrepreneurial activity instead. And the result of that is clear with the results of what happened last year. But there is a problem, and that's that only kind of less than half of 0.5% of founders pitch decks are actually succeeding. So for every 10 pitch decks an angel receives, one is of interest, right? And they make just 2 investments a year, so they receive about 10 pitch decks a week. The average angel investor, one of those is of interest, so they have about 52 meetings a year off of getting 10 pitch decks a week, and of those 52 meetings, just 2 investments a year are made by the average angel investor. When you're pitching to VCs, venture capital firms, it's a similar story. 1 in every 150 deals they see ends up closing. The rest they don't invest into. So the success rate is actually really quite small for founders. Less than 1% of businesses are being funded. Because one investor said to me, there's more money than ever than there are, there's more money available, than there are great ideas to fund. So founders are struggling, yet investors are sitting on top of this massive pile of cash that they also say they're struggling to deploy. So less than 1% of businesses are actually raising funding. So there's something getting in the way. And at Robot Mascot, we made it our mission to try and find out what that was. So I conducted loads of interviews with investors and founders. And what I found was that the biggest issue by far was being able to effectively communicate with investors. That was the biggest issue that founders were saying, what investors were saying, and that's what it really boiled down to. Over 80% of investors I talked to, apologies, over 80% of the investors that I talked to when I was interviewing them for my book said that communication was the biggest barrier. The communication of the vision and the value proposition, they didn't really know what the business did and why it needed to exist. The communication of the business case, like how are you actually going to grow this business and make it a success? And the communication of the investment returns. If I put my money, if I back you with my cash, how am I going to grow my wealth as a result? What is the return you're going to give me? These were the 3 key areas that investors wanted to know, and they weren't being told by founders. So let's imagine we've got 2 people. They look the same. To an outsider, they may even sound the same, but one's speaking English and the other's speaking French. So they're talking to each other, but things just aren't getting done. They should be working well together, but they're just not speaking the same language. Well, this is what's going on between investors and founders. You're just not speaking the same language, because investors, they speak the language of risk, assets, proof, implementation. Whereas us entrepreneurs, we love to talk about opportunity, income, possibilities, ideas. They're the things that excite us. Very few founders get out of bed in the morning to do a risk analysis. We don't really do that. We don't enjoy doing that. We want to build stuff. We want to create stuff. We want to talk about opportunities and possibilities. And this is putting a massive barrier between this typical entrepreneur and the typical investor. And this is the single biggest reason why just 1% of businesses are getting investment, even though there's more money than ever, even though there's more ideas than ever, even though there's more opportunities than ever. It's less than 1% because of this reason. So for an investor who's risk avoidant, when you go around as a founder and you talk about all of the opportunities that you have, it just sounds scary. For an investor that wants to hear about the underlying assets in the business, because it's actually the assets that drive the value of the company, the income is pretty irrelevant. For an investor that wants to see proof, the possibilities just sound like long shots. And for an investor that wants to talk about implementation, the idea itself isn't actually that important. So investors aren't getting their boxes ticked, and because of that, they're not investing. So who are they investing into? Who are these lucky 1% of founders that are successfully closing rounds? Well, investors back investable entrepreneurs. That's the term that I've called them. And these are the top, that's the name I've given to the top few % of founders who successfully close deals. So let's start with the idea of who an investable entrepreneur is to an investor, what they look like. Well, as I said earlier, an investor could invest into property, they could be investing into the stock market, but many of them are choosing to invest in entrepreneurs. And that's because they think they'll get astronomical returns. So they know it's extremely high risk. but they also know it's massively high rewards. If they back the right business, they're going to get 100 multiples of their investment back. So if your business isn't established, and by established, I mean like a business listed on a stock market, the number one thing an investor is putting their money behind is you, the entrepreneur, not your idea, but you. No one cares about your idea. They care about you and whether or not you can implement it. So someone like Elon Musk, right? He's a great example of an investable entrepreneur, regardless of what you think about him and his antics and the power he has as an individual. He could have a new idea tomorrow and people would back it without question. He doesn't need a proof of concept to raise millions. He's proven time and again, if you invest in his businesses, you get huge returns. So he's an investable entrepreneur. He's almost a guaranteed money printing machine. So if you're not Elon Musk, if you don't have this track record behind you, what can you do to attract an investor? Well, an investable entrepreneur needs to look like three things. First, they need to be highly resourceful. They're able to get people to buy into their vision, get people excited by their vision. Because when they do that, you can not only attract investors, but you can get advisors, commercial partners, top talent, all to join you on your journey. You also need to be able to show an investor that you understand the financial risks, not just the financial rewards. So you're not a blind optimist that's just looking at those big, rosy, multi-million pound revenue figures in a few years' time, but you've actually really understand the risks that you're going to need to take financially to get there. You know the risks that you're asking the investors to take. And then finally, you need to understand what commercial success looks like. You can build something that's commercially viable. It's going to generate huge revenues. It's going to deliver investors a massive return. You need to be these three things. Because if an investor looks at you and they think you're highly resourceful and you understand the financial risks, but you don't understand how to create commercial success, they're just not going to invest. If they think that you understand the financial risks and you understand how to create commercial success, but you're not highly resourceful, again, they're not going to invest. If they think that you understand commercial success and you're highly resourceful, but you don't understand the financial risks, again, they're not going to invest. It's only when all three things come together that you'll successfully raise investment. It's only when you're highly resourceful and you get people to buy into your vision. It's only when you can demonstrate that you can understand and quantify the financial risk. And it's only when you have a plan on how you're going to deliver a return that an entrepreneur actually becomes investable. If you're two out of these three things, we've got different names for these people. So the change maker, there's the asset manager, there's the leader. None of these people get the type of investment that you want. It's only when all three things come together that you get the investable entrepreneur. So how do you actually demonstrate this to an investor? How do you demonstrate you're an investable entrepreneur? Well, there's three things you need, and I call them the critical fundraising assets. There's three critical fundraising assets that you need to close the deal. The first is the pitch, right? It's the pitch that demonstrates to an investor that you're highly resourceful. Okape, I'm just going to mute you because you keep unmuting yourself, but there's a bit of background noise there. So I'm just going to keep you muted if that's okay, mate, because there's a bit of background noise that's interfering. So the pitch there is the first resource you need, the first asset you need. It demonstrates to an investor that you're highly resourceful. It's the first thing an investor will always ask for, is to see your pitch, because they want you to demonstrate to them that you're able to get people to buy in to your vision, that you're able to get people to want to work with you, that you're highly resourceful. Because when you can do that, when you can get people to buy into your vision, you can attract the capital when you need it, but you can also attract talent when you need it. You can deliver game-changing commercial partnerships that are going to allow your business to scale. You can bring on board the best advisors. All of these things happen to founders who can pitch really well. It makes them highly resourceful. So that's the first thing an investor's looking for. The next thing they're looking for is a founder that understands the financial risks. And to do that, we create financial projections because they help us to demonstrate this to an investor. They want to understand how much money you need, what your costs will be, how much you can grow the company, how quickly you can achieve it, all through your financial vision for the company. And then finally, you have the business plan. It's the business plan that demonstrates to investors that you understand commercial success. So I know the vision. I understand the financial risks and potential rewards, but I want to know how you actually plan to get me there. How do you get to that commercial reward? What's your short and long-term plans for delivering that return on investment? And this is how we demonstrate we're an investable entrepreneur, right? If you don't have the right pitch, if it's not backed up by credible financial forecasts, a believable business plan, if these three documents aren't in place, the investor just doesn't view you as an investable entrepreneur. So let's start with the pitch. Let's talk through these assets in a bit more detail now. And I want to start with the pitch because it's the first thing an investor will ask for. So the pitch is a punchy, articulate summary of your strategy. It's not your business plan. It's the pitch that gives the investors confidence in you. It's the thing that gets them excited enough by your business and your concept that they want to invest their time in finding out more. So a great pitch doesn't actually close the deal, but it is the thing that will buy you the time you need to get investors over the line. So you should always think that you're never pitching for investment. You're always pitching for the investors' time so that they can sit down with you and go through those other assets that we talked about, the business plan and the financials in more detail, and then agree to invest in you. So you always think about pitching for an investor's time, getting them excited enough, not providing them too much information, providing them enough information that they're excited enough to want to talk to you in more detail and more depth about your business. So there's a really smart way you can do this with your pitch, and I call it the setup and score format. So if we think about the content in our slides to make it really engaging and make an investor want to sit up, pay attention and take notice, we can use the setup and score format. And the idea here, think of a game of volleyball. You first set up the shot before you win any points. You set up the shot, and the setup on your slide is an engaging headline, a headline that really attracts an investor's attention, makes them lean in and want to find out more on every single slide of your pitch. So I'm not talking headlines like "our solution." They're meaningless. It doesn't tell the investor anything. You've got to imagine that an investor is flicking through your pitch really quickly and they're just looking at the headlines, and that's the only thing they're going to read. And if they're interested, they'll go back and read it in more detail. So our solution doesn't tell them anything. So let's make our headline much more engaging, something meaningful that delivers them a piece of information. So the trick here is to make the headline the conclusion of your slide. So if you can think of the headline of your slide as the conclusion you want the investor to come to, psychologically, you're already telling them what you want them to think about your business before they've read the content. So when they then read the full content, they've already got a sense of what you're trying to achieve, what you're trying to tell them. And it's a really smart psychological way of getting an investor on board with your vision and your business, is by thinking about the title as the conclusion. It's counterintuitive. It's not how we're taught to write, but it works really well for psychologically defining the way that an investor engages with your content. So you need to set up with this engaging headline that actually acts as the conclusion of the slide and guides the investor's thinking. And then you smash that home for the point. So you've had that set up and now you're smashing home for the point, getting the investors buy-in to that piece of information you're sharing on that slide of your pitch. Do that with a short, snappy piece of content that briefly expands on the point that you're trying to make. So this might be a series of bullet points or a single sentence that just expands upon the headline and gives a bit more context and a bit more detail around that conclusion you've shared in that headline. So if you can do that on every slide of your pitch, you're going to have a really short, snappy pitch that's going to get investors hooked into wanting to find out more about your business. Now, when it comes to creating your pitch and having the right assets in place to successfully close a round of investment, you actually need a number of different assets. So when I look at the top performing founders, the ones that successfully close their deals, the top few percent that actually achieve that, they tend to have the following 5 assets as part of their arsenal. So the first thing they have is their investor pitch. It's the 15 to 20 slide pitch with slides of 50 to 100 words per slide. So it's the most brochure-esque form of your pitch. It's the one that you can send an investor and they can read without any input from you. You then have the teaser pitch. This is like a 10-slide overview focusing on getting the investors to buy into your vision and your value proposition. So you're not sharing too much information about your strategy, you're just sharing your vision and value proposition. This allows you to send that pitch to investors without having to worry too much about giving away too much IP and too much detail on how you're actually going to grow the business. So it protects you slightly. It means you don't have to worry about legal terms. Mean they don't share and steal your information. So the teaser pitch is a great way to just blast your pitch out to a load of people and not worry too much about losing any control over your idea. You then have the presentation pitch. Slides similar to this one with just a few points, a few words, and then you add the context with your own presentation, with your own voice. Then you have the one-pager. This is essentially the business plan on a page. So this is a really useful tool to have in your back pocket. It's most often used when you apply to funds and angel groups. As part of the application, I'll often ask for you to attach a one-pager. Sometimes an angel investor will also ask for you to send a one-pager before they'll agree to meet with you. They might call it an executive summary. They're the same things, interchangeable terms. And then finally, you have the expression of interest form, a really underutilized tool, but one when used properly is really powerful for you managing your round, because it can be used to turn something that's like a verbal commitment with an investor into a written one before going to the legal heads of terms. So it's a great way, again, versus your peers, versus everyone else they're having discussions with and might have given a verbal commitment to. It's a great way of psychologically getting them to commit more to you than anyone else, because they've put it down in writing by filling out a simple form. So it's a really effective tool. It's usually just a one-page piece of A4, or it might be an online kind of Google form, but it's a really simple form, but it just means that they have made a written commitment to you rather than a verbal one, and somehow psychologically that makes them feel more committed to you than anyone else. So it's a really great tactic that you can use. So that's the pitch assets. You then have the projection assets. That's the next thing an investor is going to ask for. And these are really critical because they want to understand the numbers, the growth, how your strategy translates in numerical terms. And collectively, these projections need to show three things. They need to show growth, speed, and exit. Apologies, I've developed a bit of a cough today. So growth, speed, and exit is what we're trying to achieve with our forecast. Now, when it comes to growth, of course, investors are looking to see large growth. They're looking to see typically revenues in excess of sort of $15 to $50 million in revenue. So you're going to have to avoid being conservative, and that's USD, by the way. So $15 to $50 million in your forecast is where you should be heading towards if you want to get an investor's interest. You then need to deliver that at speed. You need to deliver that growth at speed. So you need to consider how you're going to get to that target over a course of about 5 years. Investors aren't wanting to wait 20 years for a return on their investment. They're typically after a return in 5 years. They know that the average unicorn has taken just 7 years to build. So a unicorn business, being $1 billion business, a business valued at $1 billion or more, on average takes 7 years to build from scratch. So 5 years to exit, if you're not planning on becoming a unicorn, is fairly realistic. 7 years if you are planning on becoming a unicorn. So we tend to show a 5-year forecast when we're pitching to investors, because that allows us to show kind of the full progress of the company from where you are now to the point at which you're going to exit. So you need to consider speed. And then finally, you need to consider the exit itself, the exit potential of the business. And this needs to be at least 10 times a return on the investment for the investor. So you need to know your current valuation and you need to know your exit valuation. And you can work out that exit valuation by finding out your industry EBITDA multiple, which I won't go into detail now because it can be a bit complicated, but you basically need to know that figure so you can multiply it by your year 5 profit, and then that will give you your potential exit valuation. And as long as that number is 10 times higher than the valuation you're doing the deal on today, the investor knows that they have a good potential of a return on investment that satisfies their ambition for their investment in you. Now, if you're pitching to VCs rather than angel investors, that number goes from 10 times to nearer 100 times, because they really are the unicorn hunters. It is go big or go home for them. So if you can't provide 100 times return on their investment, it's probably not worth pitching to the average VC. Slightly different if you're pitching to early stage VCs, but for the typical VC, you're going to have to look at 100 times return or more, whereas the typical angel investor, 10 to 30 times return is something that they're happy to entertain. So you need to make sure your projections allow for a profitable exit within 5 years and a growth that's high enough to achieve that. So that's what we're looking for in your projections. That's what an investor is looking for in your projections. And there are 5 parts to your projection that you're going to need to consider if you're going to demonstrate to an investor you understand the financial risks as well as the rewards. So the first is the P&L, the profit and loss forecast. This is a 5-year month-by-month forecast accounting and detailing your income and expenditure. You then have your cash flow forecast. So this is what your monthly cash balance in and out of the business actually looks like. So this is where you'll figure out how much investment you actually need over the 5-year period to reach your goals and how long each round of investment will last. So they want to see your cash flow as well as your P&L, because it shows a very different position in the company. They then want to see a rolling balance sheet. So a 5-year month-by-month overview of your underlying assets and liabilities in the business. So you want to be able to see the actual assets and liabilities in the business as well. And then a set of key metrics and ratios. And these key metrics and ratios will be used by investors to determine the credibility of your numbers and your strategy. So investable entrepreneurs will have already pulled these out because they're checking these ratios make sense, and they're presenting them to an investor in a way that says, I know what you're looking for. I know you're going to be doing your calculations and creating these numbers and metrics and ratios from my forecast anyway. I've pulled them all out for you because we speak the same language. We're going to be great in business together. We're going to give you all the information you need, and you can trust me with your money. So if you pull these things out, the things they're going to do anyway, you make their life easy, they're much more likely to invest in you than they are somebody else. And then finally, you should always be thinking about providing a financial summary, an overview of those forecasts. So a 5-year overview of your P&L, cash flow and balance sheet. So rather than month by month, you do it year by year. Show those metrics presented in a easy to digest table, along with charts and graphs of those things to make analysis for the investors really easy. Again, it's kind of making their job easy, makes you a much more attractive investment proposition because you show that you understand their needs. It's like selling any product, right? You're selling your shares in your business instead of selling your product. Usually you're selling your product. In this case, you're selling your shares. When you sell your product, you need to understand the wants and needs of your customers. You have to have product market fit. This is the same thing here. You're trying to show an investor that you understand their wants and needs, and you're able to deliver that information to them. And therefore, that relationship over the next 5 years, as you grow the company and they look to invest in you, is a solid one and a solid foundation, and they can trust you. Finally, we have the third of the critical fundraising assets. We have the business plan. And this is all about documenting your strategic plan for success. So how are you going to actually deliver investors a commercial return? How are they going to get their money back? You've got the numbers, but how are you actually going to do it? What does that look like in a written plan? So we've all taken a maths exam at some point in our lives, I would have thought. And we're all told in those exams to show our workings. And this is so the examiner knows that we've not just taken a lucky guess at the answer, but we truly understand the formula they're asking us to solve. And this is the purpose of the business plan, in essence. It allows founders to demonstrate to investors that they're clear on their formula for success. So it's the development of the plan that actually allows you to get clear on your strategy. So many founders put off writing their business plan until they're clear on their strategy. You don't actually write a plan when you're clear. You actually get clear by writing your plan. So without producing a business plan, you'll never be able to hold up to investor scrutiny because you just won't be able to answer their questions in terms of your long and short-term growth adequately enough. And you'll end up trying to put all this information into your pitch, and then your pitch will become too long and too wordy, and you'll alienate the investors in that early stage. You have to consider this as a approach this. Pitch is a key overview, a top level overview of what you're trying to achieve, and then the plan is where all the detail is, so that you can have meaningful conversations with investors. So how do you convince investors you're set up for commercial success? What should your business plan consist of in order to achieve that goal? Well, the business plan has to consist of your short-term plan. So this is detailing how you're going to spend this investment right now to get to your next strategic milestone. What are the key things you're going to put in place to get to that next big milestone, which could be launching your product to market. It could be scaling to 1 million users. It could be reaching 1 million in revenue. Whatever your next strategic milestone is, how are you going to spend your money, the investment right now to get there? Then you need to think about your long-term plan. How much more money are you going to need over the growth of your business? And what is that plan for growth? Are you going to launch into new markets? Are you going to launch into new territories? Are you going to create new products? What are you going to do to grow your business in the longer term? You're going to need to talk in your plan about market research. So you're going to need to think about the market size. How big is your market? How many competitors are there in that market? How do you differentiate yourselves amongst those competitors? What validation do you have? What traction do you have about your business? What proof do you have that this is something the market wants and the market needs? What are the market risks and opportunities for you and your investors? Think about the risks as well as the opportunities, because that's what investors care about. And then you're going to need to detail your marketing and go-to-market strategy. This is vitally important because investors know that the second biggest point of failure for startups after access to capital is their ability to market and sell the thing they've created. So they know as soon as they give you their money, the next reason you're going to fail is because you can't sell the thing you've just created. So the founders that raise investment are really good at letting investors know that they've got a clear plan for growing the business, for getting more customers, for launching the product into the market. Those are the founders that close deals. And then finally, you need to talk about your investment objectives and your exit plan. So you want tangible goals that you can achieve as a result of the investment. And also you need to talk about how you expect to sell the company, who you expect to sell it to, and how much you're going to be able to sell it for. Apologies. All of these things need to be considered. So an investable entrepreneur, those in the top few percent of founders raising investment go through this journey. They've created a strategy for commercial success. They've documented and shared with investors, investors as a business plan, right? They've considered and understood their financial risks and their rewards. And they've documented this as a set of financial projections for the investor to review. And they're also highly resourceful. They've convinced investors about their concept through a compelling pitch. So with these three critical fundraising assets, what you're doing is signaling to investors that you're an investable entrepreneur and that you can be trusted with their money. Now, remember, there's more money than ever being invested into startups right now. This really is the best time in history to be raising money for your venture. But these investors are just sitting on top of a massive pile of cash. And when you are an investor and you have all of this money sitting behind you, hundreds of thousands, if not millions of pounds to invest, it's all there and it just needs to be deployed. They've got to spend that money. Their whole point is to protect their wealth. That's what they live for, is to protect their wealth. And it's absolutely no good in a bank right now with interest rates so low. They don't want to keep their money in their bank. They're not getting a high enough return. It's barely keeping pace with inflation, if at all. And they want to protect their wealth, and they're doing that by investing into entrepreneurs. So all they're really trying to do is identify a good risk. They're just trying to identify a good entrepreneur to invest into. And with just 1% of founders actually succeeding, you have to be able to demonstrate you're something special. You have to be able to demonstrate that you're an investable entrepreneur. So unless they can look at you and they can see these three things, that you understand commercial success, that you understand the financial risks as well as the rewards, and you're highly resourceful, they're just not going to invest. So in the language of an investor, the way that we demonstrate these things to them is through our business plans, through our financial projections, and through our pitch materials. So this is exactly what Robert and James, our clients, Plen did. They created these assets with our support, and sorry, they just closed a massive £700,000 pre-seed round. So this was their first ever round of investment. They just had a concept. They didn't even have a working prototype, and they raised £700,000 because they had all of this stuff in place. All they were asking for was 400,000, and they ended up raising 700,000. Not only that, they were able to attract the top European and UK VCs to back their business, even though they were at pre-seed stage. They didn't even have a product yet, and most of these investors would only usually invest at much later stage businesses who had, you know, $1 million in revenue or more. They were able to attract those investors. They were able to raise more than they needed because they had all of these assets in place. They were able to convince an investor they were an investable entrepreneur. So we know it works because we've been doing it for years. And if you do these things, if you produce these assets, you're going to have that kind of success as well. If you want more information, you can get that from my book, Investable Entrepreneur. I go into this strategy in much more detail should you wish to read it. You can also check your own ability, benchmark yourself against your ability to raise investment by taking our Pitch Ready scorecard. It's completely free. It takes less than 5 minutes. You get a 12-page tailored report as well. So you'll be able to score yourself on how ready you are to raise investment by just going to pitchready.co.uk. And then finally, feel free to connect with me on LinkedIn. You can find me at James Church. I share every day. I share something to support you with your investment, whether that be some video content or some posts that will support you through the journey of raising investment, some tips, advice, guides, things that I'm seeing in the market right now that you should be aware of. And I also do the same. If you're more of a Facebook user, you can join me in my Facebook group, Investable Entrepreneur. You can connect to me on Instagram and Twitter as well, where I share very similar content. So, but my main places I live at the moment are LinkedIn and Facebook. So you can join me in my group, Investable Entrepreneur, or you can connect with me on LinkedIn at James Church. And that's it. That brings me to the end. So thanks for listening. All that's left for me to say is investors don't back entrepreneurs, they back investable entrepreneurs. And if you have any questions, feel free to raise your hand. If you've got the raise hand icon here on Zoom, or just unmute yourself, and we'll take 15 minutes of Q&A. So thank you very much for having me.
Thank you very much, James. It's been an amazing session with you. I've learned a lot, and I'm sure our leaders have also. So leaders, please use the chat box. Let's appreciate James. It's been an amazing time with you tonight, James.
Oh, thank you. I hope you've learned something anyway.
Definitely learned something, definitely. So leaders, if you have questions, you can unmute yourself or use the chat box quickly. We have less than 15 minutes.
That's it. Investors don't back entrepreneurs, they back investable entrepreneurs. That's it. That's what you got to remember. It's all about making yourself investable. Thanks for the lovely comments, everyone.
Thank you.
Best time to invest is now. Absolutely. Thanks for the cough. Yeah. Sorry about that. I think, I've gone and done a COVID test today because I've suddenly last night I suddenly got this cough. So thank goodness this is via Zoom, right? Means that you're all safe.
You'll be fine. We deeply appreciate you. We appreciate your time. And for doing this absolutely free, we appreciate that, because not every speaker speak for free. We appreciate that.
Absolutely, my pleasure. This is, for me, it's all about getting the message out there, helping founders raise investment, because it's tough. It's a tough old gig, that one, to try and get that money in. So, and it's so important. So any questions, drop them in the chat. If you are happy to stick around, but if you want to call it a day, that's okay.
Leaders, quickly, questions. If there are none, we'll be ending very soon. I believe there are no questions. If there are questions, you would love to unmute yourself or use the chat box very quickly. So James will connect with you on LinkedIn, and then we'll connect with you on Facebook. Also, we'll check out your book on Amazon.
Absolutely, yeah, available worldwide on Amazon, so you can get a copy there. You can also get a free PDF copy from our website at Robot Mascot as well. Unfortunately, we can only ship physical copies in the UK, but you can get a free PDF copy on our website if you want to, or you can get a physical copy on Amazon.
Okay, awesome. We'll do that. Thank you very much. Okay,
fantastic.
so I think there are no questions, so we'll end here tonight.
Bamboozled everyone enough, so that's all good. So have a great evening, everybody. Thanks for having me.
Thank you,
and
thank you.
And we'll speak very soon.
We'll talk more. Thank you very much.
Bye.
So leaders would continue at 7 p.m. Moyo Mamura will be joining us from the US by 7 p.m. Please, let's join in with the same link we used in joining in now. 7 p.m. everyone. Thank you all very much for joining us for this session. And please invite your friends. We want to see more leaders in attendance at 7. You want to see more leaders in attendance, invite your friends, share the link with them. Thank you very much, and see you at 7 p.m.